Reserve Accounting webinar presented by Compass Analytics and Richie May. I'm Rob Kessel. I'll be representing Compass, and Keith May will be representing Richie May. We'll get more about us shortly, but first, a couple logistics. To facilitate better audio for everyone, we're going to have everyone on mute during the presentation today. We certainly encourage questions, but please use the question box on the webinar screen to the right, and we'll make sure to get to. We do believe we have a lot of time left over for questions, so we certainly encourage questions. Also, as relates to this PowerPoint at the end, it will be available by email from Kelly at Compass or Keith at Richie, and it will also be on Richie May's website where you can download a copy of it along with the audio. Okay, so moving on to introductions. I'm Rob Kessel, co-founder and managing partner of Compass Analytics. I'm responsible for operations and business development, and Compass Analytics is a provider of pipeline, MSR, and whole loan valuation, risk analytics, and services. Keith?
I'm Keith May. I'm a partner with Richie May & Company. We're a CPA firm, management consulting firm located in Denver, Colorado. We specialize in financial services, mortgage banking, and real estate industries, and we have approximately a little over 100 mortgage banking clients across the country.
Okay. Now that we've completed introductions, let's go ahead and kick off the presentation. And what Compass and Richie May are going to do today is in a manner similar to what we did on the MSR accounting side, is try and bring a multi-discipline approach to the webinar. So I'll be covering more on the modeling, reporting, best execution, capital market strategy side, and Keith will present the specific accounting methods, current practices, and a number of related strategic considerations. So first, just to kind of set the context for the webinar today, what is the importance of loan loss reserves, and certainly our experience with our customer base is this is an area that's a little ambiguous and perhaps lacking in modeled actual discipline modeling behind it. So we have a number of bullet points here to kind of cover with respect to the importance of understanding expected future losses, or more specifically in this case, loan loss reserve. The first bullet point is very important, and although of course it sounds somewhat obvious, and that is that all originated loans and MSRs have some future loss risk. And so it's important for those, many of us in the secondary context that often think of things as transactional and ending upon loan settlement from the investor, that we still have ongoing risk with newly originated loans. We still have that continued skin in the game, whether we like it or not, whether it's a repurchase, rep or warrant risk, or the risk in the case where we're keeping servicing that we simply overpaid for the servicing. So as we think about the profitability of the loan, it's certainly not something that's stopping at the point of loan settlement. And this, of course, speaks to the second bullet point, which is that the actual losses, or on a more modeled basis, loan loss reserves, actually will impact your profitability across production. As we all know, a single buyback can wipe out profits over a large population of loans and certainly impact the kind of performance profitability metrics that we try and employ across originators or products. And that leads to our third point, which are strategic considerations. And so once we kind of get our head around better modeling of potential future losses, loan loss reserves, again, whether it's through repurchase risk or reps and warrant risk, how do we best understand and model loan loss reserves and the risks they represent? What historical data do we need to gather at what level to better price for loan loss reserves? And are we pricing loan loss reserves? Are we including it in our margin considerations or our rate sheet pricing explicitly? Are we including it in our pipeline marks explicitly? How strategically should we be deploying our understanding of modeling these expected future losses in the reserves we put in place for them? Also, how have different originators or products been more or less profitable after we have a longer horizon of time to consider their performance? How can we bring that future loss back into current pricing methodologies and actual metrics on performance? Other considerations, it's important that we understand loan loss reserves if we are in the position to keep loans in a portfolio versus sell everything to investors. And there's different tax and accounting implications depending upon whether they're sold or retained in the portfolio. So it's important that we're aware of those differences and follow the appropriate best practices. And in order to be able to support some methodology, a defensible methodology for loan loss reserves, what do we need to do? What do we need to prepare? Once we've constructed a valuation, accounting, and strategic framework around loan loss reserves and future possible losses, how do we implement that framework with auditors? What historical data do we need? How defensible must our assumptions be? And what kind of data will we need on an initial and ongoing basis to support the reporting that we need for accounting and loan loss reserve updates and estimates? So the important things to consider, and hopefully good context as we go through the slide deck today to kind of fold into your understanding. And so with that, I'll turn the next slide over to Keith.
Okay, and I'm going to talk a little bit about the accounting for loan loss reserves, and just start off. I mean, your exposure to loss risk. There's two different exposures. If you're retaining loans, you have direct exposure to losses on the loans that you actually own, and if you're actually selling loans into the secondary market, you have indirect exposure to the investors and others through reps and warranties that you're actually selling to. So it's important to understand what your exposure is. Your ultimate profitability is going to be dependent upon how well you forecast and manage your expected loan losses. So, if you're pricing in 5 basis points of losses into your margins, that's your forecast, and your actual losses turn out to be 10 bips. I mean, you've taken a significant hit to your profitability as a result of not forecasting correctly. So that's why it's important to get the exposure and manage your risk to ensure that you're forecasting what those losses are truly going to be. So let's talk a little bit about the current accounting, and I'm going to sort of split this up between upon loan sale and then thereafter. So upon loan sale, you're selling into the secondary market. An entity is required to record a recourse liability for the reps and warranties at fair value. So, and that fair value amount is supposed to be based upon an expected loss model. And we're going to talk about expected loss model, incurred loss model, a little bit more later on in the presentation, but just sort of keep those two in mind because they're significantly different. So, and then upon loan sale, basically any expected losses on MSRs, they're going to be modeled as part of the initial capitalization and ongoing value of the MSRs, so you don't have to record any additional recourse liability as it relates to the MSR. So that's the accounting upon loan sale. And then after loan sale, or if you're retaining portfolio loans, you may have to book a loss contingency or a loan loss reserve to the extent that losses are probable and reasonably estimated and exceed the recorded repurchase reserve liability to the extent you recorded something upon loan sale. And that's sort of the incurred loss model. And so the loan loss reserve model really is under the old FAS 5 contingency, which is the Accounting Standards Codification 450 now. So I mean, that's probably one of the oldest accounting standards that's out there. It's from 1975. Our accounting model is really under this accounting standard from a long time ago, and we're going to talk later in the presentation about some potential changes to that accounting model and moving away from this sort of incurred loss model that's currently in existence. And part of the reason for doing that is the current accounting model is pro-cyclical, so we tend to have low losses when times are good and high losses when times are bad, because under this incurred loss model, you're sort of projecting out your incurred losses based upon the current economic environment. So if you're in a good environment, you're going to have a low incurred loss reserve. If you're in bad economic times, you're going to have a high loss reserve, and that's sort of been sort of the issue in this last economic cycle that some of the regulators has identified as a problem. So keep in mind that incurred model versus incurred loss versus expected loss, and we'll talk about that a little later. So sort of the mechanics, the loan loss reserve, it's the basis for, booking a periodic accounting entry to estimate loss on loans. So basically what you're doing is trying to attempt to record a loss expense in the period where you've actually incurred the loss versus when an actual cash loss is incurred. The reserves are typically revised monthly or quarterly, and then the reserve is dictated by entities management based upon a review of the portfolio, the economy, various factors. It should take into account both quantitative and qualitative factors. So quantitative factors, typically you're using some sort of methodology that's measuring loss rates within your portfolio. And then the qualitative factors would include things like economic conditions, portfolio trends, lending policy changes. So I think, the OCC in one of their bulletins, 2006-47, they laid out a number of different qualitative factors that they as regulators are looking for when people go through their reserve methodology. So if you don't have that interagency policy statement, it's OCC Bulletin 2006-47. So that sort of lays out some of the qualitative factors. If you don't already have that, you might want to go get it. And then, the other thing the regulators are saying is that your model should be validated periodically based on the risk and complexity of the model. So, the more complex the model you have, the more often you really need to go through and validate it. And, the main basis for doing that validation is backtesting. Backtesting is probably the primary method of validating the actual performance of your model, where you actually are going back through historical data and tracking, what you estimated with what actually happened, and that's how you go through and sort of validate the model that you have. So I'm going to talk a little bit about methodologies, and we're sort of going to break down between retained portfolio loans and sold loans and show them sort of separately. But if you're retaining loans, your loan loss reserve methodology, you're probably going to have a specific loan level reserve for loans that you've specifically identified where you anticipate losses. So you're actually going through on an individual loan basis and identifying loans where you have some sort of problem where you expect some sort of loss, and you're specifically providing a certain loss reserve amount for those loans. And then over and above that, you're going to have a general loss reserve that's probably going to be developed off some sort of quantitative methodology for measuring loss rates. So, a simple example would be, where you have historical loss percentages based on the current delinquency status of your loan portfolio. And we presented an example there. On the left-hand side in the table, you can see you have your class or your different segments of loans, and we've sort of segmented them by delinquencies, time period of delinquencies. And then on the right-hand side, we sort of identified our risk ratings or historical loss provision amounts for those different delinquencies. And, so you're developing your reserve off of that historical loss information. So you can see the more severe the delinquencies requires a larger reserve percentage. Going back to that incurred loss, since losses on current status loans are not probable at that point in time, you're probably not going to have any reserve related to your loans that are in a current status. So that's sort of an example of a historical loss model. Probably the most common methodologies are for developing loss reserves are static pool analysis, delinquency roll rates, and the historical loss. So static pool analysis, we see this a lot in people calculating their repurchase liability reserves, where they're really taking a static vintage year like 2009, tracking their losses within that static pool of loans, developing sort of a loss rate based on that pool, and then sort of projecting that to their next layers, where your next layer is the 2010 vintage year, and you take what you know from your static pool analysis of the 2009 vintage year and apply that to 2010, taking into account any changes in pool characteristics. Delinquency roll rates is where you're sort of measuring the rate that delinquencies roll or migrated to more serious delinquencies and on to losses, and you're sort of using that as your basis for developing your loss rates in different sort of delinquency pools. And if you haven't ever seen a good example of that calculation, if you go to the OCC handbook under their retail lending section, they have a nice basic example of it. Sort of walks you through, how you would develop a loss reserve using delinquency roll rates. So, and then you can get into more sophisticated reserve modeling by taking into account credit characteristics such as FICO, DTI, current LTVs, home price forecasts, and time to foreclose sale. So, I think the more data, the more information you have available to you, the more precise you can make your reserve calculations. So then jumping forward, let's talk a little bit about reserve methodology for loan indemnification. So you've already sold the loans to an investor. So typically, if you're not retaining the servicing, you don't have a great deal of data. So it's even more difficult to estimate what your loss reserve for loan indemnification should be as opposed to your loans that you're portfolioing. So, but I mean, typically what we're seeing is companies recording a monthly provision based upon expected losses on loans sold and adding that to their reserves on a monthly basis. And right now, currently, we're seeing somewhere between 2 and 5 basis points of monthly loan sales as the amount of the loan provision being recorded. So that's sort of the starting point, and then you sort of review your loan indemnification reserve on a periodic basis and adjust it to the extent that probable losses exceed the repurchase liability that you have recorded at any point in time. So typically you're going to go through and take into account, any indemnification settlements that have already occurred where you haven't actually paid them out, where you have known indemnifications but you're still sort of negotiating them to where you're going to have some sort of loss, but it's just a matter of determining, what amount of loss you're actually going to have because you're still negotiating them. And then finally, sort of the catch-all, the general reserve, to pick up changes in performance, how aggressive the investors are being with respect to buybacks, what your exposure is depending on the type of loan products that you've been selling the last several years, economic trends that are occurring within the industry, and just what other information you have available at your disposal to estimate that reserve. So right now we're currently seeing year-end loan indem reserves running about 10 basis points of 1 year's loan production, and we've seen that sort of steady for the last 2 or 3 years. In 2012, we saw a little bit of a buildup in year-end reserves, so I think people were still providing at that 2 to 5 basis points of monthly loan production, but actual losses have dropped somewhat for most of our clients. So we were seeing them sort of build up their reserves at the end of 2012. So it'll be interesting to see what happens as we go into 2013 and, whether the companies continue to build their reserves or sort of drop back on that monthly provision amount. So with that, I'm going to turn it over to Rob, and he's going to talk about forecasting loan losses.
Right, and so as we think about forecasting loan losses, like any kind of forecast, the better understanding we have of the business principles and the dynamics underlying what would cause loan losses, the more accurately we're able to model that, whatever it is we're trying to model. And so as this slide points out, what we really take is going to be a combination of the history and experience as best we can, what we can mine from that, our current portfolio performance, But then also marry that with some forecasting capabilities where we look specifically at loan characteristics and apply business defensible assumptions to those characteristics. And of course, part of that's going to have, whether it's explicit or implicit, some forecast of the economic conditions. Much of what I'll explain below will be familiar with anyone who's modeled default or loss severity on whole loans. So if you've done that before, you'll recognize a fair amount of that. And I think a key takeaway as we go through this is that even though more complex modeling may require more validation, the greater accuracy and what we're finding in our clients, their better understanding of the underlying dynamics behind some of this modeling, the greater accuracy is going to give them better discovery to be more strategic with pricing, with some of the decisions they make, with what underwriting guidelines and overlays they may put in place. And of course, starting off with anything in modeling is always going to be a function of discoverable data, what data is available, how relevant is it, and to Keith's OCC comments, how can we point to any assumption and point to some data to make sure that that assumption is defensible. So from a historical basis, we really want to have our heads wrapped around what we've already experienced and how to turn that into assumptions moving forward. And you can think of these consistent with Keith's earlier comments as far as the kind of variables that we would need to evaluate in our back testing scenarios. So first, what kind of actual losses have we occurred? And as we know, vintage in the subprime world has been a very gross indicator of the kind of losses, most closely tracking with the property value on a national basis. But of course, beyond that, we can dive a lot deeper. What losses have we had by vintage, by product types, by the now current LTV, by state, by credit, and then from the origination side, even by channel or originator. So we've got historical data where we can start to say, well, what's been behind the kind of and the magnitude of losses we've experienced. We can start turning those into assumptions we can use on a forecasting basis. On the investor side, which investors have we experienced what kind of repurchase demands from, and what have those demands look like? As we go through the actual repurchase requests and in the settlements that have been negotiated, how can we parse from that some assumptions that we might use to best forecast actual losses on a forward basis? Next would be the scorecards and our actual performance, and not only the scorecards that any investors may give to us, the originator, but as well the scorecards we're pushing downstream to those originators selling to us. As we think about what our performance has been and how that's related to product and to the investors we're selling to, certainly that's dependent upon the actual quality and performance of the loan sold to us. And if we're thinking about modeling, we're trying to source all relevant data that we can use in our models to more accurately forecast potential losses. And so that becomes important with the actual originator's performance that sold the loan to us. And then additionally, the dynamics from the investor servicer side through the repurchase or claim process. Beyond the potential severity, their actual loss associated with their repurchase request, what are the extra expenses, the legal, the negotiation, all the different types of expenses that go along with an actual settlement in the end, how we add that on to the potential severity assumptions so we best calculate what potential losses we have. And so that's historical data, and hopefully we have precious few data points to work off of. We don't have too many foreclosures or too many repurchase requests or demands, and hopefully fairly low delinquency, especially with recent vintage originations. Hopefully we don't have a lot to go off of. But on a forward basis, what kind of assumptions can we employ? And that, of course, is not only going to be based on loan characteristics of loans we're originating today, but also some, again, implicit or explicit macro and local economic assumptions, such as house values and employability, et cetera. So what are some of these? How do these models, what are the variables that we use in modeling? First is we want to be able to look at a probability of default. And so the probability the borrower will stop making payments. And so some of the drivers there we might look at would include credit, equity in the house, economic factors. And note that many of these, of course, are not going to be static. They're going to be changing over time, and it's going to be part of what we're going to be updating on a period-over-period basis as we reassess what our loan loss reserves are based on having more information available to us from the actual variables going into these assumptions. Loss severity is going to be the expected future sales price. So when we think about that, that's got some assumption for house price appreciation in a given market. It's got some assumption for what kind of sale that is likely to occur in a loss-emit environment. And then from that, we're taking out unreimbursed costs, actual expenses, again, all the different pieces that go along with loss-emit, less whatever the loan balance is. So we're trying to really have our head around severity, whether it's the aggregator investor that purchased it or not. We're trying to figure out what the potential losses are. That's going to be the big driver of the demand back to us, even if we repurchase and try and liquidate. Repurchase frequency. So what is the likelihood of a reps and warrants loss or claim or buyback request? And again, here we try and look at what we have from a historical point of view. This might be an area where we try and look at, in our experience, what might be fraud-based versus just performance or borrower-based. But how, if a default event occurs, is 100% of those defaults pushed back as repurchases? What percent is? And then, of course, there's a lot of different model drivers associated with this. One being prepayment. In the subprime days, many of the subprime loans were prepaying so fast that defaults were mostly ignored because loans would pay off before they could get in a default situation. And it's not the case so much today, but prepayment does take on a surprisingly large impact on potential loss severity. So prepayments matter. That means, of course, that interest rates matter. So there is interest rate sensitivity to your loss reserves because of how they influence prepayments and affordability. House, which tails into house values, of course, drives equity in the property and willingness to default and loss severity. And of course, some of the other things I've mentioned, economic forecasts, how quickly, what state, what type of foreclosure process, moratoriums, the like, might be in a given state that might affect the ability to foreclose, the timing to do so, to get it to REO. And then to the extent there are types of rep warrant expirations from the aggregator point of view, maybe some don't expire, others do, but how can we model that? And then, of course, key loan data, product. And this, again, speaks to my earlier comment. Any information we can surface that gives us better input information to business assumptions. So product type, QC findings, credit, pay history as we think about seasoned loans, FICO, DTI, and again, when we have loans that have already been sold, we're often thinking about that we need current data as opposed to what the data was at origination. That's not always easy to come by. And of course, house price appreciation is not always easy to put in place across every MSA or every zip code in the country. So how are we coming across that? Key origination data, so how we're mining on the originator side, what's their performance been from a delinquency, foreclosure point of view, prepayment point of view, how have they done from a QC, fraud point of view, is there any operational deficiencies in the originator that might turn into potential repurchase claims, all different things that might impact your loss reserves. And the final thing we note here is that Keith made an earlier comment about how MSRs are, by virtue of how we model MSR values, they are supposed to be inclusive of all of these different assumptions, delinquency, et cetera. But we should note that as we update our assumptions for loan loss reserves, those assumptions very well could also be driving changes in the MSR value. So that although there's not a loan loss reserve change per se for the MSR, you can have MSR value differences for the same kind of variables that would drive the change in loan loss reserves. And let's go to the next slide then. Okay. And so, in this, of course, we're trying to put in with a slight simplification, just to kind of express this in a little bit simpler terms. But we're trying to look at this on a loan level basis. We're trying to consider all the different loan level characteristics and the broader macro characteristics. We're trying to bring those into actual calculations that lead to loan loss reserves that then can be aggregated up for whether it's monthly or quarterly, but can be aggregated up to actually look at balance sheet changes period over period that might lead to income recognition or losses. So first we start with what is our repurchase exposure, and that's our expected repurchase frequency times our expected losses, and our expected losses are the expected default times an expected severity. Next, the identified repurchase exposure, so that's the identified repurchase frequency, what we observed, times actual losses. And then we just note that we'd be adjusting these variables would end up being adjusted on with whatever frequency, monthly or quarterly. So we expect these numbers to adjust period over period. And before I hop off this slide, Keith, anything you'd want to add to what how I've laid out this slide or what I've talked about?
No, I think you just sort of model. Here's my expectations. Here's what's actually occurring, and take that information into account and go back and adjust your original model as a result of that. So.
Okay, and then if we can go to the next slide then. And we have here is just a couple samples, and how Compass would look at it using our framework, some of the different assumptions we'd perhaps make, just to kind of case the topics we've been discussing in a little bit more numeric sense for some of the gearheads on the phone. So first I'll start with a newly originated loan, and let's just, for the sake of this sample, assume we have a 1.5% probability of default. And default can show up in the form of a CDR that full loan modelers might be used to thinking of, or for MSR models it might be more a combination of delinquency stages, 30, 60, 90, all the way through foreclosure and final disposition. But there's some driver, there's some credit model, perhaps a function of LTV, DTI, FICO, other variables that are really behind coming up with that percent of probability of default, 1.5%. Next would be a loss severity calc. So for here, the assumption came up with a 10% loss severity. Now, certainly not all loans have loss severity. If you have a 50% LTV, you're not going to have a model loss severity. And of course, that also is going to be a driver in the probability of default. But it's important to calculate the potential loss severity. So we're looking there at the future LTV when we were actually able to sell the product, how we sell the product, how long it takes to foreclose an REO and sale, of course, is relevant to that. And then what the associated costs are in the process, those that come out of pocket, and here you're modeling the end investor's loss, not just your own potential loss, because that's what's likely behind the claim amount. What's the repurchase frequency? So there is a default event. What percentage of loans are you going to be requested to repurchase, or will there be claims coming back to you for? This is going to be a function of the investor, the originator, QC findings. So again, these would all be modeled off of variables that you would have discovered, believed to be predictive, and ultimately will be able to provide data to backtest that would go into looking at loan level data to derive these types of percentages. So we put those all together in our loan loss reserve and basis point. In this example, on new production, 3.75 basis points, or the loan amount times 3.75 basis points as the loan loss reserve. So that's just a simplified example on a newly originated loan. And as we think about this on an ongoing basis, there are a number of things that are being updated. Certainly our principal reduction, if we have scheduled principal, in some cases voluntary principal reduction, that's lowering our LTV, putting more equity in it for the borrower. If there's credit-based events, pay history, economic employment, economic type data, other exogenous shocks. As we progress in time, we have more information available to us, and we can pass those through into loss reserve models so that we update loan loss reserve estimates. Actual delinquencies and prepayments. Prepayments, as we go through time, we can back test our forecast of prepayment versus an interest rate scenario, look at where interest rates are, see how we're comparing in actual prepayments. House values, we're printing tickets every month on different MSAs with respect to house price movement period over period, so we have that data as we move forward in time. For those aggregators, investors, where they have rep warrant windows for certain types of defaults, that's occurring as we go through time, that may moderate the amount of loan loss reserve necessary. And again, to my previous point, MSR values, of course, are often changing with the same values. So this becomes a parallel process to the kind of modeling we might do on the MSR portfolio. And then, of course, we also have more experience with actual claims. Newer vintages, we see what's happening. Investors, if there's broader changes on the investor community, Fannie's coming out looking for more repurchases, Freddie's backing off, policy-related things, FHFA-related things. So those are all things that might come up through time that could influence our assumptions that would go into changing loan loss reserves. And again, all of these OCC level, thinking about this, I need defensible assumptions that I can back test and or point to different inputs so that my assumptions are defensible. Okay, and then I think go to the next slide then. And
all right, and
I think we'll turn it back to you, Keith.
Yeah, absolutely. So just follow up on how this sort of rolls into the financial statements. It's a fairly simple presentation. Your loan loss reserve as it relates to loans that you have sitting on your balance sheet end up being presented as a contra asset to those loan balances. So they reduce the actual loan balances. And then for loan indemnification reserves, since you already sold the loans, they're no longer sitting on your balance sheet. Those are presented under the liability section on the financial statements. Write-offs are taken directly against the loan loss reserve balances. And then on the income statement, the loan loss provision for both examples are going to reduce earnings via an expense line item on the income statement for your loan loss provision. And then finally, to the extent you have MSRs and your losses are factoring into the value of the MSRs, whatever MSR value you're carrying on the balance sheet would be reduced. The valuation would be reduced by that amount to reflect that. And then just from a sample journal entry standpoint, I mean, relatively simple. As you add to your reserve, you're going to debit your loan loss provision, credit the loan loss reserve, or your indemnification reserve on a monthly, quarterly basis, whatever. And then as you actually incur a loss, you're going to reduce that reserve and either record the actual cash that you're sending for an indemnification or actually reduce your loan balance. So I think the important thing from an accounting standpoint is just realize you want to capture everything within the reserve. So all your charge-offs, all your recoveries, your loss provision, all of that should be going through the reserve account so that everything's flowing through that loss reserve account. So that's pretty much it from a financial reporting standpoint, and I'll turn it over to Rob, and he's going to talk about sort of the data and reporting information considerations.
Yeah, and so as we think about the modeling, and boy, that's exciting and neat that we can get as accurate as possible with coming up with these reserves, and we could start to use this information from an origination point of view, underwriting point of view. That's great, but what work do we need to do? What kind of data do we need to do in order to facilitate generating these entries, the reports behind the entries, the actual modeling itself, and the actual period over period data, portfolio data that would really drive some of the underlying assumptions we're using. And so in many cases, this is a little bit of a leap in data relative to what a lot of originators are used to. So as we think about, well, how do we come up with historical performance, we really need the servicing performance on loans both sold on a released and retained basis, or at a minimum, if we can't from the investors get the actual servicing type data, then we need to be able to be alerted to delinquency and foreclosure statistics, which is not always the case. And so, in our view, as more and more originators recognize the importance of being able to track their own performance, that they'll start requesting for more and more of this data from the aggregators, explicitly ask for it, and start to aggregate themselves the performance of their loans across all the different investors to which they've sold those loans, and start to actually have much better data around their actual performance. And again, that's very key in that it's not only going to be for loan loss reserves, it's going to be originator product-related data that can give us the actual delinquency performance, but also prepayment performance. And so many of the originators out there keeping loans, keeping servicing, or perhaps experiencing early payoff payments from the different aggregators they sell to, if they have this kind of data on a go-forward basis for all the loans they've sold, then they also can generate prepayment statistics that they can then turn around and use in figuring out how much to pay for servicing for different originators and further improve the profitability or accuracy of their pricing. So there's a lot of values in being able to have your the actual performance of the loans that you sold over a long period of time for all of the loans you sold. So that's one consideration there, and there are likely shortcuts you can use when you can't get that data and still mine what data you do have. To that end, then, is that as we get those monthly updates, we're going to marry performance data with whatever other macroeconomic, interest rate, other type of any kind of other house price appreciation or other variables, broader variables that might influence our assumptions, and taking that all together then on a monthly basis, just like we do with pipeline hedge accounting entries and MSR entries, model this out on a loan level basis, aggregate it up, and be able to produce change in loan loss reserves period over period, month over month, quarter over quarter, based on the actual output of the reports. And of course, that leads to the monthly balance sheet and financial statement entries that would come out as a standard report. So I'll turn it back to Keith.
All right, quickly just talk about the tax impact of reserves. I mean, unfortunately, the IRS doesn't follow the GAAP accounting methodology. They tend to be much more conservative in their definition of what a loan loss is. So as a result of that, we all often get pushback from our clients that aren't getting deduct their loss reserves as a result of that. But small banks, there's a special carve-out where they get to deduct a reserve based upon their loan loss experience in the current and 5 prior years. Larger bank, that's not really available to them. They're sort of on a losses as incurred methodology. To the extent you have loans held for sale sitting on your balance sheet at the end of the year, you're typically having to follow the mark-to-market rules. And that includes credit quality. So to the extent you do have your some loans sitting there that you have the portfolio, that probably have scratch and dent type values, there is an opportunity to write down those loans held for sale below cost as a result of those mark-to-market rules. And then finally, under loan indemnifications, typically, the IRS is only letting you record a loss when a liability has been incurred in sort of effects and circumstances situation, but typically a settlement has to have been entered into, or you're close to a settlement and you're just negotiating the final terms. But for the most part, you have to actually have incurred a liability, and most of your general reserves that you're recording on your balance sheet, you're really not going to get to deduct for tax purposes. So that's sort of the negative side of loan loss reserve from a tax standpoint. And then briefly, I'm going to just talk about some things that may happen in the future. And a lot of these are being driven by regulators, Basel III. There's sort of a major push to reduce the cyclical nature of the current accounting focus approach to reserving for loan losses. Basel III is wanting some sort of, whether it's capital or loss reserve, some sort of countercyclical buffer that they feel should be adopted by regulators, and we're seeing some of that in the capital requirements that just came out under Basel III. And the main goals is to make loan loss revisions more forward-looking, and then sort of result in more timely recognition of credit losses, and provide for more transparency regarding credit risk. So as a result of that, the Financial Accounting Standards Board issued an exposure draft back in December 2012 related to credit losses, and they originally started out developing sort of a three-bucket impairment model for financial instruments, and then they got a bunch of feedback, went back to the drawing board, and basically said, that's too complicated. We're going to go with something simpler, and they've come up with sort of a single impairment model for all financial assets that's going to sort of replace the multiple credit impairment models that we currently have, under our accounting standards. So, so some of the key provisions of the exposure draft is going to be based on a single measurement objective that would reflect an entity's current estimate of the contractual cash flows that are not expected to be collected. And that's sort of where you're sort of estimating what your loan losses are going to be over the expected life of the loan or that financial instrument. So that's sort of the expected loss models, as opposed to what we're currently on is the incurred loss model. So obviously you can see if we're sort of basing our reserves over our expected losses over the entire life of the loan, not just those that we feel we've already incurred, it's going to significantly balloons everybody's loan loss reserves from where they currently stand. And that's sort of what the regulators, the FASB, is looking forward as far as this counter-cyclical. We want some additional buffer to cover those losses that we know that's going to happen when you hit a bad economic downturn. So this impairment is going to be reflected as an allowance for expected credit losses. Sort of removes the existing probable threshold for recognizing credit losses. You don't have to have a loss that's already probable. Again, it goes to, you're going to base it on a broad range of information that you're going to have to consider in estimating what those losses over the life of the loan is going to be. It could be based on past events and then sort of projecting those forward over the economic cycle of that loan life. Whatever forecast you have related to collectability is going to be included in that. And the last item, it's going to always reflect both the possibility that a credit loss results and a possibility that no credit loss results. So sort of a probability-based estimate. So you're not going to be able to use a best point estimate calculation using some statistical model like a lot of people are currently doing. So you have to take various probabilities into account when you go through and estimate it. It's going to apply to all entities, and it's going to apply to pretty much all financial instruments, all debt instruments, debt securities, loans, anything that's measured at amortized cost or fair value with changes in fair value going through other comprehensive income, fair value-OCI. It's going to include lease receivables recognized by lessor, as well as any loan commitments. And then they sort of did a carve-out that you wouldn't have to apply to those financial assets measured at fair value OCI if both of these criteria are met. And basically, expected credit losses are insignificant on those instruments. Then you're not going to have to actually go through and do that calculation. Other consideration, it doesn't really prescribe this specific method to go through and estimate these expected credit losses over life of the financial instruments. The board's feeling that companies are going to be able to take, their current risk monitoring systems and basically use those to do this implementation and sort of expand it over, incurred loss period to the entire loss period and the entire loan life, so they don't think it will take, major changes in sort of the risk monitoring systems. And, they give some examples as far as, taking historical data and updating it for forecasts out into the future. It also doesn't really prescribe the unit of measure, whether you're going to do it based on individual loans or pool of loans, or they're really leaving that up to companies. And then, to the extent there's a time value of money factor into the calculation, that's going to have to be taken into account either explicitly or implicitly. And then regarding the financial statement presentation, somewhat similar to what the current model is. So basically, financial assets that are at amortized cost, you're going to present the amortized cost less a contra account for the allowance for credit losses. Those financial assets that are fair value OCI, you're going to do them at fair value, but then you're also going to have to disclose net amortized cost less your calculated allowance for credit losses. And then loan commitments, loan indemnifications, again, those are going to be on the balance sheet as a liability. The provision for credit losses is going to be recognized in earnings for the amount of the credit loss required to adjust the allowance for credit losses in the current period. So as soon as you originate a loan, you're going to estimate what's my anticipated loss on the entire life of that loan, and I'm going to book a loss provision and a loan loss reserve of that amount at the point of origination, and that's going to be my calculation. And then as far as write-offs, again, you're going to write off financial assets when there's no reasonable expectation of any future recovery. So, that's an exposure draft. It's been out there for a while. They've changed it a little bit. They haven't determined an effective date. Most of the big accounting firms are saying, it's probably January 1st, 2016 at the earliest as far as an implementation date. And, my guess is there's probably some sort of implementation period to where, there is some, since it's going to be a significant impact probably as a result of the change, maybe there's some sort of time period over which you implement that. But those details have not come out yet. We'll see as things progress where they actually end up. But just want to put that out there because if it goes through, it's going to significantly change how people are going through and calculating their loss reserves. You're probably going to use similar data, similar information that you're using now. You're just going to forecast your losses over a longer time period than what you currently are doing. So, and with that, I'm going to turn it over to any questions that anybody may have. And Rob, can you see the questions at all, or am I the only one?
No, I'm not. I think you're probably going to have to read them off.
Let me see if I can. You mentioned that typical loan loss reserves are 2 to 5 basis points of monthly sales, but year-end adjustments are an additional 10 bips consistently for the past 3 years. Would that not justify increasing the monthly reserve rate, or is it because the year-end adjustment is specifically related to legacy issues? So I'm sort of talking about two different things when I talk about 2 to 5 basis points. I'm talking about the monthly provision that people are adding to their reserves, and then the 10 basis points is sort of what we're seeing our companies ending reserve balances at the end of the year. So their year-end reserves are probably reflecting about 2 years worth of losses. So if you're assuming 5 basis points of current year's production and you have an ending reserve of 10 basis points, then you're looking at companies having built up a reserve that would cover sort of 2 years worth of losses. And that realize that reserve is taking into account any actual losses that you've incurred and written off. So, if at the beginning of the year your reserve is 10 basis points and you added in 5 basis points for your provision, and it's still 10 basis points at the end of the year, that probably means you wrote off 5 basis points of losses during the year to keep that consistent. So that's sort of the difference between the 2 to 5 basis points and the 10 basis points that I was talking about. Are early payoff fees included in loan loss reserves, or are they a different animal due to their short-term nature? I've seen it accounted for separately or as part of the loan indemnification piece. It's usually calculated separately just because, you know, there's a short duration to where the payoff fees or the early payoff fees, there's only a certain time period as to when they're going to be incurred, and you can almost look back and say, you know, here's what our losses related to early payoff fees are going to be, and you can either take that and add that as a component of your loan indemnification reserve, or a lot of times I see sort of a separate reserve just for those early payoff fees as a separate calculation. And, you know, a lot of times companies want to track that expense separately, so they'll track that in a separate loss provision so that they can sort of track their loan indemnification losses separately from their early payoff expenses separately, but sort of seen it done both ways. What are some ways to calculate loss severity and repurchase frequency? You want to take a shot at that, Rob? I'll chime in maybe afterward.
Yeah, and I'll start with the loss severity, and it's certainly not trivial, but what you're really trying to figure out and kind of dig into loss mitigation and the process there is for a given property in a given state where it goes into default at some time, and you kind of have to make assumptions as to when in the future the loan might go into default and how long it would take to go through the foreclosure process to REO process to how long you would take to sell the loan. And you know, that's the time horizon you're trying to look at for that particular loan, and then look at that next to some kind of assumption on where house values are. And you might say they're flat. You might say in the last couple of years they've been up 2 and 3% a year, but that gives you the sense for what a house might sell for that in that future date and time. And then from that point of view, you'd further look at and say, how would the house be sold? Would it be a distressed sale that wouldn't sell at a regular HPA adjusted number? Would we assume that it would sell at whatever the future house value forecast would be? And how we'd figure that out would be looking at the current value of the house and then multiplying it times some housing index to get what we think the future value would be. That kind of gives us an idea of what we have coming in the door. Then we have to subtract out the costs. So there, again, it's in the loss myth, but it's things like a realtor commission, things that would be consistent with your servicing or common industry practice servicing conventions. But real estate commission, all the different fees associated with maintaining the property, any of the unreimbursed type advances depending upon the investor, cost to advance for escrow or the like. And what you're doing then is you're figuring out, based on this future proceeds from the sale, net of commissions and costs, comparing that to what the then current balance would be on the loan. And of course, in those events, you have customers not paying down principal for quite a period of time since they're not making payments. Those are the dynamics, not trivial, but that's the general framework we use in coming up with what severity would be on a loan. And repurchase frequency, I think it's talking to peers, it's looking at your own experience, it's getting a sense for investors with, in the event of defaults, how often those are coming back as repurchase requests. I don't know if you want to add anything to that. I know we're about at the end of our time now, Keith, but anything you want to add to that?
Covered everything pretty well, so. And I think that's all the questions I have on the board right now. So I think with that, we can probably wrap up. If anybody has any questions or any feedback for us, you have both Rob and my email. there on the last page. As Rob said at the beginning of the presentation will be on our website shortly, and you're welcome to request specifically via email for the PowerPoint presentation. We'd be glad to send that off to you guys. So, Rob, do you have anything you want to add?
Nope. Appreciate everyone's time and interest, and encourage anyone to bounce any questions off of us.
Great. With that, we'll finish up, and we thank everybody that attended, and we look forward to you next time. Thanks again.